Recently, the question that's been on every investor's mind is this: Bitcoin or precious metals like gold and silver? Before answering that, we need to put the recent sharp pullback in Bitcoin into the right perspective. Moves like this in the market are rarely caused by a single factor. The reality is usually more complex. Liquidity tightening, large players closing positions, liquidations in derivative markets, and shifts in global risk sentiment all combine to create these moves. In the short term, price falls, but that doesn't always mean the long-term story is broken. At this point, investors naturally start looking at alternative assets. Especially gold and silver have shown historically strong rallies over the past few months. While gold is testing new highs, silver has reached levels not seen for a long time. Behind this rise are wars, central bank policies, and geopolitical uncertainty, but the real key factor is the quiet accumulation by governments and large institutions. Silver has become a critical input for sectors like energy, semiconductors, electric vehicles, and AI infrastructure. Supply-side pressure has pushed prices sharply higher. Gold shows a similar picture. Record-level buying by central banks is shrinking the free supply in the market. In periods like this, prices don't just rise, sometimes they move almost vertically. But here's an important distinction. Just because an asset is going up doesn't automatically make it a good investment. This is where risk metrics come in. Sharpe ratios, which reflect the risk-return balance, have reached historically extreme levels for both gold and silver. In the past, when these levels appeared, long correction phases often followed. The distance from the 200-day moving average also shows how stretched prices are. Precious metals are currently trading far above their long-term averages. What does that tell us? There may still be upside, but the risk has already increased significantly. When we look at Bitcoin, the picture is the opposite. Price is down, sentiment is weak, and attention has faded. Historically, these are the periods that feel the hardest emotionally, yet offer the strongest opportunities mathematically. Logarithmic risk models show that Bitcoin is currently in a much lower risk zone compared to past peak periods. Of course, further downside is always possible. But investing isn't about finding something that will never drop. It's about identifying where the potential reward is highest relative to the risk you take. Right now, precious metals are what everyone is talking about. They dominate headlines and generate heavy FOMO. Bitcoin, on the other hand, is questioned, criticized, and out of favor. Experience shows one thing clearly: the best opportunities usually appear when something is least loved. So the real question isn't gold or Bitcoin? The real question is, which asset offers me the best risk-reward balance today? That's a personal choice. But the data suggests being cautious where excitement is extreme, and being careful yet brave where interest is low. If there's one takeaway from this video, let it be this: don't confuse price with value. Don't mistake hype for opportunity. And you don't have to buy everything that's going up.